Hello everybody, welcome to join our webinar brought to you by Bursa Malaysia. And today, this webinar is titled Profit in Bull and Bear Markets with L&I ETFs. So what exactly are L&I ETFs? They are leverage and inverse ETFs. Today, we are going to study how retail investors like us can profit in the bull and bear market in the L&I with this instrument called L&I ETF. So if we are able to use these instruments, then we can have a recession-proof income, because even in a recessionary period, we should still be able to make money with these L&I ETFs. So today, we are very excited because we had invited a renowned ETF issuer in Malaysia to share with you about this L&I ETFs. All right, so are you ready? So if you are ready, please type, yes, I am ready. Okay, let me know. If you are ready, type, yes, I am ready. All right, cool. Excellent. Thank you so much for your responses. Yeah, for some of you asking who exactly can trade L&I ETF, don't worry, our speaker will share with you who are eligible to trade this L&I ETFs. Right? So yeah, disclaimer, whatever we share on this webinar is only for educational purpose. In no way that give you any buy or sell signal for you to trade any leverage or inverse ETF. So if you decide to trade any, you do it at your own risk, right? So it gives me a great pleasure to introduce this speaker, and she is currently the director of ETF and Innovation Lab of Affin Hwang Asset Management Berhad. She is responsible for developing strategies and products for the exchange traded funds business within Affin Hwang Asset Management. She has over 13 years experience specializing in wealth management products. Prior to Affin Hwang Asset Management, she has worked with Alliance Bank and Standard Chartered Bank. So she holds a Bachelor of Science degree in mathematics from National University of Malaysia. Okay, so she is my senior. I also graduated from National University of Malaysia. All right, so she is none other than Chong Li Zhu from Affin Hwang Asset Management. All right, Li Zhu, we're happy to have you with us today.
Hi, thank you, Shane. Good evening, everybody.
All right, cool. So we can't wait to get started. So let me just make you a presenter and take you over.
Okay. Okay, you can see my screen?
Yes, perfect.
Okay, let me just put in presentation mode.
Yeah.
Okay.
All right.
All right, good. Thanks, Shane. Welcome everyone to this session sponsored by Bursa Malaysia. In fact, you know, I want to hang on, yeah. Okay, so what I'm going to talk about today is L&I ETF, which is leverage and inverse ETFs. So you can understand what I'm going to share tonight. It's quite a heavy topic because leverage and inverse ETFs are rather new in Malaysia, and you will need some time to digest the information that I'm going to impart on you tonight. All right, so what I'm going to do first is to walk you through what leverage and inverse ETFs are, and then from there you can then learn how L&I ETFs actually work and how they behave in different market environment. And then I will also show you how some of the you know, our investors, or how you as an investor can use L&I ETFs in your portfolio. And last but not least, you know, we we can't just talk about the good. We need to talk about the risk that is associated with trading in L&I ETFs. Okay, so I hope all of you are ready to in this heavy session. Okay, I'll try to make it as easy to understand as possible. Okay, now let's take a look at what are leverage and inverse ETFs. So if we know what ETFs are, if you have attended Shane's recently conducted a webinar on what ETFs are and what are the available ETFs in Malaysia, you will know that ETFs are actually index trackers. Okay, so they are different. They are similar to unit trust funds, but different in the way that they are very passively managed, which means that they do not, the fund managers do not pick and select what stocks to buy, but they will just merely track a particular index. Okay, now leverage and inverse ETFs, on the other hand, are made or designed to actually provide investors with varying exposure to the underlying index. Okay, so index trackers like the plain vanilla ones, like the normal ETFs, just track your index. If the index goes up, it goes up. If the index goes down, it goes down. Now, there are two types of ETFs in Malaysia, which is called the 2x or 2 times leverage ETF, which aims to give you twice the daily performance of the index, which means that if the index is up 1% today, the 2 times leverage ETF will be up times 2, which is 2%, okay, close to 2%. Now, on the other hand, we have a hedging instrument, or an instrument or ETF that you can profit from the bear market, which is the inverse ETF. So it's very similar to you shorting the market, shorting futures, or even similar to buying a put warrant. Okay, so what it means is that if the index were to go down by 1%, this inverse ETF will be up 1% instead. Okay, so it gives you the inverse performance of the particular index, right? Now moving on, so LNI ETFs, I always like to start and say that it actually have some similarities to warrants. Why do I associate with warrants? Because today a lot of Malaysian actually trade warrants, and you understand what warrants are. So in order for you to kind of relate to warrant, LNI ETF are similar in the sense that they track the index futures price, right? And they also have market makers to provide liquidity. So today, if we talk about ETF, I know a lot of you here will have this concern, right? Every time I do a webinar, people will ask me, are you sure ETF can buy in Malaysia? Because ETFs have so little to even zero trading volume on a daily basis. So, but a lot of people do not understand that there are actually market makers in place that provides liquidity to investors so that you can actually buy or sell at any point of time you like, right? But unlike warrants, LNI ETFs do not have an expiry date. So one thing about warrant is that when you invest into warrants, you need to always monitor the expiry date, and you are told, you know, or advised not to hold the warrant till its expiry because it may expire worthless. But LNI ETF don't have an expiry date, so you can typically hold it as long as you like. But of course, there are risks involved, which later on I will explain, right? And the second thing about LNI ETFs that are a bit different from warrant is the fact that it has a typically lower gearing or leverage ratio. Like I mentioned, the leverage ETF only gives you 2 times exposure, okay? So the gearing is only 2 times, up to 2 times. Whereas the inverse is just -1 time, all right? So we can't even leverage on the inverse. But if you buy, let's say, a call or a put warrant, the gearing can easily be, you know, anywhere between 3 to sometimes 10 times, right? So that is the benefit. So for those of you who wants to look for leverage exposure but do not want to go too extreme, say to like warrants where you get 3 to even 10 times, and if that scares you, then you can try out the 2 times leverage ETF. So how then does the LNI ETFs actually achieve its daily targeted return? Okay, so this can be a bit complicated. So essentially, how we get the 2 times leverage exposure for investors is that, you know, for a unit trust fund, right, we have the AUM in place, right, or the NAV in place. So with that NAV that we receive or collect from multiple investors, we will then invest into the futures contract. All right, so that's why the 2 times leverage ETF and the inverse ETF will actually track the futures price, not the index price. So in the case of the 2 times leverage ETF, the fund manager will long the index future, and for the case of the inverse ETF, the fund manager will short the index futures for you. So for those of you who are familiar with the futures market, you will know that you can actually go long or go short, right? So instead of you having to learn about the futures market by buying into these products, you are already getting yourself exposed to the futures market, but you don't have to worry about, when, the mechanics or the technicality of it. Now, so when we long the futures for the 2 times leverage, assuming if the NAV is at 100, which means the fund size or the market cap is at 100, we will then long futures worth up to 200, right? And you know that, if you buy 200 ringgit or worth of the futures contract, you do not have to commit or pay 200, but usually we will just need to commit a margin deposit for the futures contract, which usually could be just 10 to 20% of the exposure that you're getting, okay? So of course, the remaining balance will be sitting in cash, where the fund manager will then invest into short-term bonds or money market and cash, so that the money that we have, that is the balance, we do not leave it idle. So we will still make the money work a little harder, all right? Now, of course, for the inverse ETF, if the NAV is at 100, we will short the futures worth 100 ringgit. And only about a maximum of 15% will be committed as the margin deposit for this future contract, right? So L&I ETFs are actually rebalanced daily to meet its objective, okay? So think about daily rebalancing as like a deposit account, okay? So let's say today, if you have a savings account that says pays you 3% interest rate per annum, but on a daily rest, your return for that one whole year would actually be more than 3%, because your interest is given to you on a daily basis and compounded over time. So if you were to calculate your return for this savings account, the return over this 1 year is actually not 3%, but more than 3%. So this daily rebalancing actually gives you the compounding effect, okay, which I will walk you through now. Now let's take a look at the 2 times leverage ETF, okay? So this is how the daily rebalancing actually works. So like I said, today, if the fund actually has 100 ringgit, right? So on day 1, the fund manager will go to the futures market. We will buy or long 200 ringgit worth of the futures contract, right? Now, let's say today, if the index were to go up by 10%, then the return for today will be 200 ringgit, because that's the exposure that I get from the futures market, multiply by 10%, and today we made 20 ringgit, okay? Or rather, the fund made 20 ringgit. Now, on day number 2, what happened is that I have my 100 ringgit yesterday, and I added or realized my $20 gain, okay? So which means day number 2, I will start my fund's NAV at 120 ringgit, okay? So what the fund manager will do is, because now I have 120 ringgit, I need to double up from the 120 ringgit. So we will then go and long 240 ringgit worth of futures contract. So if you were to compare this to the first day, we have already increased our exposure to another 40 ringgit. So let's assume today the index actually make a loss of 10%. So you will have to take 240 ringgit, because that is the exposure of the futures contract, multiply by this loss of 10%. So we have a loss of 24 ringgit for day number 2. Now, day number 3, we have to take the 120 ringgit that we had yesterday morning, net off the loss that we made for the day, which is 24 ringgit. And on day number 3, we start our fund's NAV at 96 ringgit. So based on this 96 ringgit, again, the fund manager will double up its exposure. So now we will have to long 192 ringgit. So what you notice is that on a daily basis, the leverage ratio is always rebalanced to 2 times. So there won't be any instance where we will go above the 2 times leverage, all right? So day number 3, if the index were to make a gain of 10%, then you will make $19.20, because 192 multiplied by 10%, okay? I hope you guys are not blur as of now. Okay, so this is actually the effect of the cumulative return over a period of time. So in the same calculation that I did as per the previous slide, you will notice that over the 3 days, the 2 times leverage ETF return is actually equals to 15.2%, whereas the underlying index has only given you a return of 8.9%. So then you will ask me, right, hey, how come the 2 times leverage ETF is not 8.9 times 2, right? Because if you take 8.9 times 2, then you actually get close to 18% return. But you will notice that the 2 times leverage ETF return over a period of a period of time will not be equals to just simply multiplying the underlying index return by 2. Okay, because of the effect of this compounding, right? So that's why just now I give you the scenario, of the savings account where it gives you 3% return, but because it's on a daily rest, right? So every day you realize your profit, you compound your returns again. But in this case, because there are losses that we incur, so when you compound them over a period of time, you don't get the 2 times exact returns. Okay, so how do we then actually calculate the cumulative return? So it is actually based on the formula like this. Okay, so 10% on day 1, let's say this is the index gain, 10% on day 1, day 2 down 10%, day 3 up 10%. So you actually need to calculate 1 plus 20% and then multiply by 1 minus 20% and multiply by 1 plus 20% minus 1. So that's how we get the 15.2% return for the leverage ETF return. Okay, so some of you at this juncture may be thinking, oh no, this is like mathematics already, I'm not good at maths. Okay, so it's okay, because what is important here is that you need to understand that when you take the returns of this leverage ETF over a period of time, it won't be 2 times return exactly, right? Later I will give you some other examples of real cases. Now let's take a look at the daily rebalancing mechanism for the inverse ETF. So let's say on day number 1, we had 100 ringgit. So fund manager will then short the futures market, the futures contract by a negative 100. Okay, so if the index make a loss of 10%, then it's good news for the fund, because if the index is down because we shorted the index, we make a gain of 10 ringgit, right? Day number 2, okay, we have to again reset or rebalance our exposure. So today, yesterday I had 100 ringgit and I have also made $10. So now I start off the fund with 110 ringgit. So again, on day number 2, I will have to short the futures contract worth 110. So in this case, let's say today the index make a gain of 10%, which is not in our favor. Then in that case, you will make a loss of 110 times 10%. So for today, we make a loss of $11 in the fund. Now day number 3, 110 ringgit minus 11. We will start off day number 3 with 99 ringgit in the fund's NAV. And because we have 99 ringgit, I need to rebalance my exposure to 99 ringgit short. All right. So if the index make a loss of 10% for the day, then again, you make a gain of $9.90. Okay. So this then is the graphical illustration of the returns over the 3 days. Right. So as you can see, over the 3 days, the inverse ETF return is positive 8.9%, but the underlying index return is actually negative 10.9%. Again, I want to draw your attention to the fact that if you hold the inverse ETF over a period longer than 1 day, you will not get one-time return exactly. Okay. Now, so again, how do you calculate the cumulative return? You apply the same formula. You need to take 1 plus day 1's return and then multiply it by the second day 1 plus the second day's return, and then multiply it again, 1 plus the third day's return minus 1, and that's where you get 8.9% return over these 3 days. Okay, so let's talk about what are the L&I ETFs that are currently available in Malaysia. Okay, so Afin Huang Asset Management actually were the first to list leverage and inverse ETF in end of November last year. So we are short, just a little bit short of a year in terms of track record. But later on, I will share with you some of the track record of these ETFs that we have. So we listed 4 ETFs at one go, end of last year, which is the TradePlus NYSE FANG+ Daily Leverage and Inverse Tracker. So it has the stock code 0830EA and 31EA, and then followed by the TradePlus HSCEI. HSCEI stands for Hang Seng China Enterprise Index. So for those of you who are familiar with the HSI warrants, the Hang Seng Index warrant, the HSCEI index is also listed on the Hong Kong market, but the only difference is that it tracks Chinese companies listed in Hong Kong rather than the pure Hong Kong companies. And our friendly competitor Kenanga actually listed the Kenanga KLCI Daily Leverage and Inverse ETF early this year. Okay, so what essentially this pairs of ETFs will do or will give you exposure is that if you take a look at the NYSE FANG+, actually that is is quite an interesting ETF, because the exposure that you are getting is not Malaysian stocks, it is the FANG index. All right, so what's in the FANG index? There are companies that are listed in the US, so it's Facebook, Amazon, Netflix, Google, Twitter, Alibaba, Tesla, Nvidia, Baidu, and what is the other company? Slip my mind. Okay, I'll talk to you when I recall. Okay, now the TradePlus HSCEI, okay, it tracks the 50 largest companies, Chinese companies listed in Hong Kong. Okay, now and the Kenanga KLCI, of course, this is tracking the KLCI index. So for example, today market is red, the KLCI is red. You could have taken opportunity on buying into the Kenanga KLCI Inverse ETF to profit from it. Okay, now, so how can you as investors actually use L&I ETFs in your portfolio? All right, so I have split, I split this into 10 years, into short term and medium to long term. So you will notice that for both the leverage and inverse ETF, they can be used for the short-term basis. It could be days, it could be months, all right? Sometimes if there's opportunity, you can even do intraday trading, right? So of course, if you have a very strong view that the index is on an upward trend and you want magnified returns of up to 2 times but not more, then you can look into the 2 times leverage ETF. But if you have a strong view that the index is going to be down on a downtrend for the next couple of days or even months, and you want to profit from this market decline, you can then buy into the inverse ETF, right? Or for the inverse ETF, if you want to hedge your market risk, let's say you already hold some of these KLCI stocks, right? Maybe you hold, Genting, Top Glove, blah, 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 etc., right? And you think that, in the short term, the market is coming off. So what you can do is you can, without having to sell the shares that you have, you can then buy into the inverse ETF as a hedge to your portfolio, right? And if you notice that for the medium to long term, i.e. for months or even to years, we do not really recommend holding the inverse ETF, because if you take a look or pull out the charts of an index over a long term, over a longer period, most likely the index is on an uptrend, right? Longer term usually is on an uptrend with shorter term volatility. So it is not advisable unless, of course, you really think that this particular index is going to be down for a long period. But the 2 times leverage ETF, if you are really confident that the market is actually on an uptrend, but with volatility in between, and if you don't mind that your returns are not exactly 2 times the index, then you can choose to hold 2 times leverage ETF for a longer term, right? Now, the next question that we always get is that people always ask, how do we time the entry or exit for leverage and inverse ETF? Now, if you are a technical analysis person, you can actually apply technical analysis on the ETFs, but you do not apply it on the ETF, because if you take a look at the ETF volume, because it's low, sometimes the closing price is not reflective of the actual futures closing. So what you need to do is you need to pull out the futures chart that the ETFs are tracking, and then apply your technical analysis on top or over the futures pricing. Then you will get a very accurate entry and exit signal. Okay, so let me give you example of trading using the EMA9. I'm not a technical analysis person, but this is what I picked up from one of the M+ webinar that they had recently, and I thought this could be something that is interesting, because all of you here, if you are applying technical analysis, you would have your own favorite trading strategy that you like. So I'm just giving this as an example. So in the EMA9 strategy, what happens is that if you have a closing of a particular candlestick that is above the EMA9 line, then it indicates an entry signal, right? So like, for example, in this case, if you enter because of this signal on the 12th of August, you would have entered the ETF at $7.44. Okay, that and because we're talking about the NYSE FANG+Index, and this candlestick that I've pulled out is actually the NYSE FANG+Index Future. Okay, so because we know the difference in time zone, if the entry signal is generated on the 12th, which for us, we can only take action on the next day, which is on the 13th. Okay, so you buy on the 13th, and if you were to write this signal, or rather this pattern, all the way up to the top here, all right. Of course, you could have chosen to sell there at the peak, but nobody can foresee that that's the top. So what happens is that you will then hit into an exit signal on the 3rd of September, because the candlestick for that night, the closing, has actually closed below the EMA9. So what, again, because it's on the 3rd of September, we can only take action on the 4th of September. So we would have exited the leverage NYSE FANG+ leverage ETF on the 4th of September at $9.17. So within this 2 weeks period, you would have made 23%. All right. Now, how then can you backtest your strategy? For example, the HSCEI Index Future. Okay, so first of all, you need to determine your entry date or point by applying your technical analysis on the index future. So like I said, you do not apply it on the ETF, but you apply it on the futures. So like HSCEI leverage and inverse ETF, we track the HSCEI Index Future. So you can go to, say, I use TradingView. You can go to TradingView and pull out the HSCEI futures contract, and again, look at using your own signal, you decide on your entry. All right. Now, because the ETFs are not really very liquid, not to say not illiquid. The trading volume is low. So when there is no trade for today, Bursa will take the last transacted price, which could be yesterday, as the closing price for today. So if you were to plot your chart on TradingView using the ETF, it may not give you a very good picture. But the difference, the thing is that for the market makers, when they quote the price on the exchange, they do not take that last price. Okay, so they always adjust the beep and ask price in accordance to the live or real-time NAV or the price. All right. So when it's not being transacted, it really does not mean that there is no liquidity. So what you can do for this example is that, okay, say for example, in this case, right, you want to backtest your strategy. So if you want to use the same strategy, your entry signal would have been 1st of October here, all right? And assuming you want to hold until today, what you can do is you can go to our TradePlus.com.my website to view the performance simulator and by selecting the dates. So if you were to enter on the 1st of October and exited on the 23rd of October, you can see in this chart, the fund return of the HSCEI daily 2 times leverage is 14.68%, right? So of course, you know, you can't, there's no one straight answer or easy way for you to backtest. You need to make reference to multiple platform, all right? So one of the questions that I always get is that, can LNI ETFs be held for the long term? Because we were told, or we have to emphasize the fact that leverage and inverse ETFs are meant for shorter term trading. But does it really mean that you cannot hold it for long term? I personally don't think so. Why? Of course, inverse ETF, if we talk about inverse ETF, like I said earlier, we do not recommend you to hold it for the long term unless the market is really, really bearish, right? Secondly, the leverage ETF can actually be held over the long term if the index is generally still on a long-term uptrend. But like I said in my previous slides, one thing that you need to remember is that when you hold it for long term, it will not give you 2 times the return of the index. And it could potentially be worse off than the index return, which I will show you example, right? Let's take a look at the S&P 500. Today, a lot of you may have this question. Is LNI ETF a new ETF that we as Malaysians invented it? The answer is of course no, right? Because we always lack the US market. So in the US, LNI ETF have existed, way back in maybe 2008 or so. If I were to take an example of the S&P 500 futures versus the performance of the S&P 500 2 times leverage ETF, you will see that since launch in 2014, the S&P 500 futures is up 81%, but the 2 times leverage is up 128%. So if you ask me, okay, can you then hold long term, right? My answer to you is it really depends on you. If you have the risk appetite and you know the risk of holding it long term, then by all means, because if you were to hold the S&P 500 futures or even the S&P 500 ETF, your return will only be 81%. But taking an additional risk, you actually can get up to can get more than the one-time return, which is 128%. Now, like I said, not every time it will be 2 times or slightly less than 2 times. Sometimes you can be worse off. Like for example, on a year-to-date basis, the S&P 500 futures is up close to 6%, 5.94%, but the S&P 500 2 times leverage is actually up only 3.8%, right? And this 3.8% is probably due to the large a drawdown that we had, because when you have a large drawdown, it kind of multiply your losses 2 times, right? Now, next, let's take a look at the TradePlus NYSE FANG+Performance for this particular ETF that we have launched. Like I said, we listed it on end of November, 27th of November last year, and the 2 times leverage ETF has ever since then is up 136%. So we listed it at about $4. It is now trading at about, I think today was at about $8.90 or something like that, $8.90, and the high was at about 10 ringgit. So personally, if you think that the FANG index or the technology index will continue its uptrend, then again there is no right or wrong in holding the ETF long term. Okay. And if you can take a look at the year-to-date returns, the FANG futures is up 74%, but the FANG 2 times leverage is up 115%. So it's lower than 2 times. But if you were to take a look at the 6 months return, the return is actually closer to 2 times. Why? Because over the past 6 months, it was a very, very strong uptrend market. So that's why if you, like I said, you know, in the 3% savings account example, if you have your daily compounding, if only markets are up every single day, you compound your returns, you will get more than 2 times return. All right. Okay. So I want to address this thing where people say ETFs are not liquid. Okay, so many of you here may not know that ETFs have market makers to provide liquidity. Okay, so if you take a look at this chart or this screenshot that I have actually pulled out for you, it's all AHAM's ETF, right? All Affin Hwang AM's ETF. And what I want to draw your attention to is look at the buy queue and the sell queue. If you have traded the small caps before, you will know that when stocks are illiquid, you don't even see a quote, right? Or the spreads could be very, very far away. But in all our ETFs, you will see quotes, and these are typically quotes quoted by our market maker. And for the HSCEI L&I ETFs, our spreads are really, really tight. It's at 1 cent. Right, so there is plenty of opportunity for you, for those of you who are looking to do intra trades, to make a few cents over a day if the market is volatile, right? And you will see that our HSCEI market makers always quote 1,000 lot, and the FANG will be 300 lots, right? So all this quotation in terms of the quantity will be refreshed by the market maker on a time to time basis. All right, so it doesn't mean that, let's say today if somebody were to take up the 1,000 lot, does it mean that there's no more ETF units available? The answer is no, because the market makers have actually more than 1,000 lot to offer to investors, right? So once somebody has taken up the 1,000 lot, the market maker will quickly replenish the quote to add on another 1,000 on the sell side. Okay, now all right, so after talking about the goods, how you can use leverage and inverse ETF in your portfolio, now let's touch on the risk. So of course I have to highlight that when you invest into L&I ETF, you have to take on long-term investment holding risk. Like I've said many times, the fact that when you hold it over a period of time that is more than a single day, there is no guarantee that you will receive 2 times the return of the index. So you have to be prepared to take on that risk if you want to hold on for a longer term. Leverage risk, because if you invest into the leverage ETF, you are leveraging up or doubling up your exposure, so your gains or losses can be magnified. And inverse performance risk applies to the inverse ETF, which means that if you think that the market is going down but it goes up instead, you actually will stand to lose out in those cases or scenario. Now, portfolio turnover risk, because in the earlier slides I did show you that the L&I ETFs have to be rebalanced on a daily basis, because we do not want to exceed the 2 times leverage, and we do not want to exceed the -1 time inverse exposure, and that's why the fund will have a high turnover, all right? Because on a daily basis we need to adjust our futures exposure, and that would incur cost. Futures investment risk, as we all know, because the ETF actually invests into the futures market or futures contract, you are exposed to futures investment risk. And last but not least, trading hours difference risk. This only applies to the FANG ETF, because as you know, the US trading hours and our trading hours is actually different, and it doesn't overlap. So you will actually see very little price movement throughout the day for the FANG ETF, right? So just now, earlier on, I think Shane did ask, how can investors actually trade the Malaysian listed L&I ETFs? So first of all, you need a trading account or a brokerage account with a broker in Malaysia, right? I believe most of you, or even all of you here, would have an account with any brokers. And on top of having just a trading account, because these products are very, very new in the market, the regulators actually requires investors to sign a declaration form. So you need to fulfill one of these criteria. Sorry, the last pointer should be D. I don't know why it's changed to A. So you need to fulfill either one, just one of these 4 criteria, and you will be qualified to trade. So all you need to do is contact your broker, sign a form to declare that you have met A, B, C, or D, right? So the first criteria is you are a sophisticated investor. Sophisticated investor means investors who have 3 million net worth and above, right? So some of you say, so much I don't have, right? So never mind, then skip A, move on to B. Do you have a margin account? If you have a margin account, also you can qualify yourself to trade. But some of you say, hey, I don't trade on margin, I don't have. Never mind, forget about B then. Look at C. So C says you have executed at least 5 transactions in exchange traded derivative or warrants. So it could be futures or warrants in the past 12 months. And some of you may also say, hey, I've not invested in warrants. How? So then need to meet D law. Okay, D is actually the easiest to fulfill, because as an investor, you just need to utilize a performance simulator, which I already showed you just now. Go to our TradePlus.com.my website. You will be able to see the chart. Okay, insert those dates, and you can play around with the performance simulator. All right, just need to play around with it, and then go to Bursa Marketplace website, right? And watch, I think, 6 videos if I'm not wrong. And these 6 videos basically talk about what is leverage and inverse ETF, what is the risk, how do you how does the rebalancing strategy works. So it kind of sum up what I've actually share with you tonight, right, in a video format. So if you find my presentation boring, then just head over to that site, watch the video, and then you will be able to qualify yourself to trade the LNI ETFs, right? But I do know that some of the brokers in Malaysia, despite having just to sign a declaration form, may not be so ready to accept clients. Because for instance, I know Rakuten Trade will not even allow, because they don't have this form on their platform. So unfortunately, if you go through Rakuten Trade, you will never be able to trade the LNI ETFs, right? So
your webcam is off. Would you want to turn it back on? Your webcam is off.
Oh,
Would you want to turn it back on? Yeah. I don't know why, maybe you accidentally off it.
Okay, sorry. All right, so the videos on Bursa Marketplace. So this is the video that I mentioned. So there are 6 videos in total. So you can actually go in and watch all these 6 videos. And at the same time, go to the TradePlus.com.my website, or if you are interested in the Kenanga KLCI leverage and inverse ETF, go to Kenanga's website to look for this performance simulator. So in this performance simulator, what it does is it allows you to play around with the dates, okay, and then it gives you the return of the fund over that period. This is to basically educate investors how the performance of these ETFs will perform in different market scenario, right? So I've come to an end for our presentation. So if you have any questions at all, please feel free to ask. Shane, back to you.
Thank you so much, Li Chu, for your sharing on LNI ETF. So now that we have learned a great deal about LNI ETF, we have also even learned the compounding effect of an LNI ETF. So for leverage, remember, for leverage and inverse ETF, the return is on daily basis. Okay, the manufacturer exposure is on daily basis, so it's not over a longer period of time. So remember that if you hold it over a longer period of time, then the return may not be exactly like the one indicated on the ETF. All right, so thank you, Li Chu, for your wonderful sharing on how to profit in the bull and bear market using LNI ETF.